it is important to start considering whether there are options available to you that could give you a boost in your future savings or retirement plans, or simply help you prepare for your best financial future. Are you in a position where you're approaching those retirement years? When does it really start? At age 60, you can access some of your accumulated super even if you are still working. You can do this through a transition to retirement income stream. There's no barriers to entry. You just can't access lump sums. But you are able to draw a regular income stream equal to somewhere between 4% and 10% of the account balance each year. This could help you to transition to retirement by reducing your work hours and supplementing your income from super. You could use the extra payment to help pay down some outstanding debt before you hit full retirement. Or perhaps, because the payment you receive from the transition to retirement income stream will be tax-free, maybe you can salary sacrifice some extra money back into super and reduce your overall tax liability. For super purposes, being over 60 and changing jobs mean you are considered to have retired. You can enjoy the same benefits I just mentioned around a transition to retirement income stream, but with two additional benefits. First, you aren't subject to the 10% maximum drawdown limit. But be careful, this doesn't mean taking it all out is the right thing to do, as you will lose some of the taxation benefits super offers. When you move into a retirement phase pension, the earnings, including any capital gains on the assets used to support your pension, are tax-free. If you want to keep working, then that's fine too, knowing that at age 65, you can start to draw down on your super, even if you want to continue to work. All investments carry some form of risk. For some investments, the risk is higher, such as investments via the share market, where the value of your investments can fluctuate up or down on a daily basis. But even conservative investments, such as cash and fixed interest, carry some risk, which might be that they won't generate sufficient returns for your future needs. As you approach or enter retirement, there can be a natural inclination to move towards more conservative investments. But it is equally important to think about how long you want those savings to last. Reviewing your position is important, whatever stage of life you're at, and you should do this regularly, at least once per year. Another matter you should consider is how much are you drawing out of your super each year in the form of regular payments. It's your super, and there are no limits to how much you can withdraw from super. But just remember that once you take the money out of super, it gets harder to put it back if you change your mind, particularly from age 75. Whilst there are no maximums, there are minimum pension requirements that need to be withdrawn each financial year. If you transferred your money to a retirement phase superannuation pension, the question might be, do you need to draw more than the minimum? Sometimes the answer is to set up a regular payment to ensure the minimum is paid out over the course of the year, and then to make additional withdrawals at times of need. This way, you're only drawing out what you need. Now, the minimum payments are recalculated every 1 July based on your account balance as at 30 June. The calculated minimum payments may go up or down from one year to the next, so it's important to stay in control of your finances and know how much is coming to you in the future if you don't take any action to adjust, and then adjust it as is needed. At BT, we believe it's important to help you prepare for your best financial future. Everyone is different and situations can change. This is why we recommend you speak with a professional financial advisor to work out what options are right for you.